Congratulations! You are in the enviable position of having enough extra cash each month to pay down your mortgage. But you aren't quite sure if it's a good idea to pay down the mortgage because it's a low fixed rate. I'm Mitchell Hockenbury, and I'm going to explain to you the pros and the cons of paying off your mortgage early. As interest rates begin to creep up from the historical lows we have become accustomed, I have been asked if it's a smart idea to hold on to a low, fixed rate mortgage for as long as possible rather than pay it off early. Now there's a couple of assumptions the person holds. One, interest rates are going up, and then two, that they're going to be in the home for more than a decade. Now going purely off those assumptions, I can see where the person is coming from. The low fixed rate mortgage in a rising interest rate environment is a hedge against the rising interest rates themselves. However, it isn't simple as math. There are a few questions that come to mind. Are you planning on putting money away in tax-deferred accounts? Are you already doing so? Are you disciplined? And by that I mean, will you take the extra money and invest it? And if so, in what? I mean, if we're talking about a savings or a money market account, that's much different than if we're talking about investing in the stock market. If you're not disciplined, paying off the mortgage early can serve as a forced savings plan. What other investments do you have? If you're only in one asset class, that's much different than if you're diversified. There are some emotional questions to ask yourself. How important is it to be debt-free? Will you sleep better in a home that isn't owned by the bank and cannot be foreclosed? What amount of your take-home pay is going towards the mortgage? Okay, that's 7 questions I just posed, and I do have more, but asking more questions isn't going to make it any clearer of an answer for you. So let's get this narrowed down to assist you in answering the question yourself by looking at the pros and the cons of paying off the mortgage early. First, the pros. You're debt-free. The bank cannot foreclose, and if you were a dual income family, it may provide the opportunity for one of those spouses to quit or retire from work, or do something that they truly love, like volunteerism, because collectively, you're not relying on the second income to pay on this large mortgage payment. You're provided some freedom and less stress when you don't have that $1,500 to $2,500 a month payment. Now the cons. You have less liquidity. The appreciation is tied up in the home. The year 2008 and 9 taught us homes don't always go up in value. It would be so sad to pay off a mortgage to find out it's worth much less than you paid. Additionally, you may miss out on a good upswing in the market that your extra cash could have been invested. You must think in terms of opportunity costs and the mortgage rate. Then think at a strategic level. I cannot give you an answer without specifically knowing the answers to the above questions, but I can tell you my general thoughts. If you have extra money, I'd like you to first contribute to an emergency fund. Once it's full, then max out your savings towards retirement. Then towards other goals like education for the children or to purchase a car in the future. Then pay down the mortgage as fast as you can without it becoming too painful. Once you have the mortgage paid off, there is peace of mind that that cash is freed up and you can use it however you see fit. Thanks for watching this video on paying off your mortgage early. If you haven't seen my video on how much should be in your emergency fund, please do so now. And if you've learned anything of value, subscribe to Personal Finance YouTube channel and visit personalfinancemadeClear.com for more resources on investing and mortgages.